Measured, observational tone. Every time you tap a screen to pay for coffee or check a balance, your request is instantly fired across a sprawling digital infrastructure. The physical action takes a fraction of a second, but it sets off an immediate chain reaction of automated approvals, risk assessments, and ledger updates deep behind the screen. Millions of these small, routine choices are processed every minute. They are continuous data points feeding directly into a centralized financial network worth trillions of dollars. This living machine is tethered to your daily habits, operating as a direct extension of your personal choices. The sheer scale of the American financial system can easily overwhelm the ordinary families who rely on it to survive. This immense structure constantly moves wealth across the country, dictating which businesses expand, which neighborhoods develop, and who faces financial ruin. The central question is how the architects of this system actually direct that flow of money. Once you remove the physical cash, the engine relies on a layer of abstraction, a collective agreement that these digital numbers hold value, even without the presence of paper. Navigating your own financial life requires a clear view of how this invisible ecosystem handles those agreements and manipulates wealth behind the scenes. One of the most powerful gears in this machine is credit. It allows individuals to acquire capital they don't actually have, creating money by borrowing against the value of their future labor. This is a 1959 American Express card. The printed expiration date and embossed account numbers you see here formalized personal reliability into a trackable physical object. Today, that tracking has evolved into the modern credit score. This 3-digit number acts as a mandatory passport to participate in the contemporary economy. A high score opens doors to affordable loans and favorable terms. A low score mathematically penalizes the borrower, subjecting them to aggressive interest rates and steep fees. Credit serves as a systemic measure of personal reliability, strictly controlling upward financial mobility for millions of Americans. The largest application of this personal debt is the residential housing market. Look at this 1913 note and mortgage document. When a family buys a home, they sign a contract like this, transforming a localized promise to repay into a binding, tradable financial asset. Central institutions control the master lever of interest rates, manipulating them to stimulate or cool down the housing market. A minor percentage shift by distant bankers translates directly to higher monthly payments, instantly locking millions out of the market. Home ownership requires the successful navigation of institutional debt and shifting rate currents. Beyond personal debt, the machine relies on equity. The stock exchange is a volatile engine where the potential growth of corporations is aggressively traded. While Wall Street is heavily populated by institutional traders, millions of everyday workers actively participate through retirement accounts. By contributing bi-weekly savings into a 401k, ordinary families are steadily purchasing fractional ownership in the world's largest companies. This is a length of stock ticker tape. These printed company symbols and fractional numbers do not measure the current reality of a business, but rather the exact quantification of its expected future value. This mechanism makes the system a real-time psychological thermometer. Sudden fear can evaporate wealth in hours, while collective optimism can multiply it just as quickly. Investing connects your personal retirement directly to the collective trust and anxiety of the entire nation. Modern consumers face immense pressure from rising baseline costs, aggressive interest rates, and unforgiving credit algorithms. This machine is undergoing a rapid technological evolution. Digital algorithms now process thousands of complex financial choices every millisecond. This digital transformation makes the banking system incredibly efficient, but it simultaneously creates an opaque environment that is highly dangerous for an uninformed user. As the financial machine becomes increasingly invisible and automated, blind participation is the greatest financial risk an American can take. The technological interface of money is rapidly changing, but the foundational mechanical laws of debt, equity, and trust remain absolute. Financial literacy operates as a necessary cognitive defense mechanism against a system built to extract wealth. Making highly strategic, informed micro-decisions today alters a person's trajectory within this massive network over time. Mastering these hidden mechanical laws allows you to ultimately manipulate this massive financial engine to your distinct advantage.